Welcome to the Explainer. Today, we're diving into the ultimate government-approved VIP substitute for standard depreciation, corporate capital allowances. If you've ever wondered how businesses actually get rewarded by tax authorities for making massive, expensive investments, well, you are in the exact right place. Let's get right into it. To navigate this complex tax terrain, we're going to follow the chronological life cycle of a hypothetical business asset. We'll quickly cover 1, the tax depreciation substitute, 2, qualifying your capital assets, 3, the 4 allowance types, 4, restrictions in fine print, and finally, number 5, the end of the line. Starting off with part 1, the tax depreciation substitute, and how it solves the write-off problem. Okay, so put yourself in the shoes of a business owner for a second. Let's say you just bought this massive, incredibly expensive piece of machinery. Naturally, your accountant calculates standard depreciation, right? They want to spread out that huge cost over a few years. But here's the catch. The tax authorities completely disallow standard accounting depreciation for income tax purposes. They flatly reject it. So what do? Well, that's where capital allowances step in to save the day. This is the government's official, legally allowed tax relief granted to a company that incurs qualifying expenditure for its trade or business. It's essentially the approved way to get your write-off. Moving right along to part 2, qualifying your capital assets. What actually makes the cut? Because look, before you can claim a single dime of this relief, your asset has to officially qualify. The absolute golden rule here is that the asset must be wholly, exclusively, necessarily, and reasonably used for your business at the end of the basis period. But what does that actually look like? Well, the categories for qualifying capital expenditure, or QCE, are honestly incredibly diverse. We're talking about everything from big industrial structures like factory mills and mechanical workshops, all the way to your standard plant, machinery, and fixtures. It even extends out to massive mining and agricultural operations, plus modern investments like research, development, and brand new software. It's a pretty wide net. There is, however, a critical compliance threshold that you absolutely have to remember, and that is 500,000 naira. If the total value of your additions to property, plant, and equipment exceeds 500,000 naira in any given year, you can't just claim the allowance under the radar. Nope, you are legally required to submit an application and obtain an official acceptance certificate from the Federal Ministry of Industry. It's a strict rule, but a super important one. Now, you might be looking at these strict compliance rules and thinking, wait, what if my company is small? How on earth do these rules apply to my little startup? And honestly, that's a great question. Well, the tax code is very clear on this, and 25 million naira is your magic number. For small companies that are generating revenue under that 25 million naira threshold, these capital allowances are simply deemed utilized during the periods those companies are tax exempt. Basically, you don't get to stockpile these allowances and carry them forward. You only truly start claiming and carrying forward these allowances once your revenue crosses that 25 million mark and you officially grow into a medium or large company. All right, let's hit part 3, the 4 allowance types and exactly how you calculate your relief. Once your asset officially qualifies, it is time to actually calculate and claim your money. First up, we have the initial allowance, or IA. Think of this as the immediate, upfront reward for your purchase. It is a one-time relief granted in the specific year of assessment that the qualifying expenditure was first incurred. You get this just once in the entire life of the asset, for as long as it remains beneficial, owned, and actively used by your business. Right after that, we have the annual allowance, or AA. So while the initial allowance is your big upfront reward, the annual allowance is more of a slow and steady relief. It's a straight-line deduction granted every single year on the residue, which is just the remaining balance of the qualifying expenditure after you've deducted that initial allowance. You basically just chip away at it year after year based on the asset's unexpired life. Now, what's really fascinating here is how these exact rates tell a story about government priorities. The government uses these to heavily incentivize specific behaviors. For example, if you're undertaking super capital-intensive mining operations, they grant you a massive 95% initial allowance right out of the gate. That's huge. But if you're just buying basic office furniture and fittings, well, your initial allowance is a much more conservative 25%, followed by a 20% annual allowance. And on top of the basics, we have investment and special allowances. The standard investment allowance for plant and equipment is 10%, but you really have to look at these rural investment allowances. The government literally rewards businesses for providing their own infrastructure. If your trade is located at least 20 kilometers away from government facilities, you get compensated. No tarred road, 15% extra allowance. No water, 30%. No electricity, 50%. And get this, if you operate with absolutely zero government facilities at all, you receive a staggering 100% rural investment allowance. They are quite literally rewarding you for being your own municipality. Oh, and similarly, approved manufacturing in an export processing zone, that also nets a 100% allowance.
Okay, let's ground ourselves a bit with Part 4, Restrictions and Fine Print, also known as the Rules of Engagement.
Because let's be totally honest here, the tax authorities do not just give away endless freebies, right? There are strict rules of engagement you have to follow. And this right here brilliantly illustrates one of the absolute strictest rules in the book. Allowable deductions for capital allowances are legally restricted to 2/3, so 66 and 2/3% of your assessable profits for the year. That remaining 33.4%, that represents your taxable assessable profits. This rule is basically there to ensure that no matter how many assets you purchase to claim relief, your business is always going to pay at least some amount of tax to the government.
However, there are a few exceptions to the rule. Companies engaged in the agro-allied industry and manufacturing are entirely exempt from this 2/3 restriction. But for everyone else, you've also got to be really careful with prorations. Say you use a company motor vehicle for private errands on the weekend, the taxman is going to restrict the allowance granted to the official use portion only. Makes sense, right? Also, if your basis period, like your financial year, is less than 12 months, you have to do the math and prorate your claims down to the exact number of months in that period.
So we've purchased the asset, we've officially qualified it, claimed our allowances, and navigated all those restrictions. But what happens at the end of the asset's useful life? What actually happens when you finally sell the asset or maybe close the business entirely?
That brings us to our final section, Part 5, the end of the line, and making those balancing adjustments.
When a business finally disposes of machinery, the accountant actually has to reconcile the books through a pretty straightforward 3-step disposal workflow. Step 1, identify the tax written down value, or TWDV. Step 2, compare that written down value to the final sale proceeds you received, or the insurance claim if the asset was destroyed. And step 3, determine if that difference results in what's called a balancing charge or a balancing allowance. So let me break down the difference between those two. If your sale proceeds are greater than the tax written down value, you have a balancing charge. This essentially means you claimed a bit too much relief over the years and the government wants a refund. It acts as an additional taxable value, kind of like a clawback. On the flip side, though, if the sale proceeds are less than the written down value, you get a balancing allowance. And this acts as one final additional tax break to cover the financial loss you took on the asset right before you disposed of it. Finally, what if the entire business permanently ceases operations? Well, there's a specific rule for that too, called the cessation carryback rule. Upon complete cessation of a trade or business, any unabsorbed capital allowances from that final year can actually be carried backwards in time. You literally claim them against the remainder of profits from the penultimate year, then the pre-penultimate year, going back to a maximum of 5 years prior to the business closing. Technically, this triggers retroactive tax refunds from the authorities, which, as you can imagine, is a massive financial lifeline for a company that's shutting its doors. So the crucial takeaway here is that understanding capital allowances is absolutely not just a dry accounting exercise. It is a critical, highly valuable strategy to legally protect your profits. Which leaves us with one final pre-provocative thought to consider as we wrap up this explainer. How much unclaimed tax relief is sitting in your business right now? Thanks so much for joining me today. Take these insights, go check those ledgers, and I will see you next time.